Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are here with David Skarica, investor, speculator, and author of soon-to-be-released book, Mega Returns, Profit from Maximum Pessimism. He discusses financial bubbles, debt cycles, and investment opportunities in various sectors. David, thank you for coming back on the show.
Yeah. Thanks for having me. It's great to be here. I know you were sick for a few days. I don't know if your people know that. So we kind of had to backtrack this, which was fine. I'm pretty flexible in my, I'm, I live on the island and I just work all day and I'm pretty flexible with my schedule. So,
Good. Yeah, thank you. I appreciate that. I was under the weather and just stuck in bed, but I'm feeling much better now. Let's start off like we always do. And what is your macro view of the world economy and financial markets today?
I'm kind of a real contrarian at the moment. And I kind of always tend to be a contrarian, but really at the moment, where what scares me is, I am like politically, I don't want to offend people, but I am kind of very libertarian and conservative. So I was definitely not disappointed that Trump won. But like the issue I have is this, remember Alan Greenspan in the mid 90s, this irrational exuberance, where if you look at everything from sentiment indicators, like market wise, value indicators, there's not even just like the typical sentiment indicators like investors intelligence and AAII and stuff like that. It's like just like asking retail investors, if they're bullish on the stock market. It's like overwhelmingly bullish. It's like some of these indicators are 20, 30 points higher than they've ever been. And with the valuation of the stock market and a lot of indicators like price to sales, market cap to GDP, being in like the 99th percent, realm, I'm really worried that we're seeing this irrational exuberance or too much optimism, thinking that all this deregulation and cutting red tape and maybe cutting taxes is going to lead to this huge boom. And one thing that's interesting, and I mention it quickly in the book, I don't really go into it in detail, but there's a great book by John Kenneth Galbraith called A Short History of Financial Euphoria. You can get that on Amazon. Is that he talks about that all these busts like 1929, 1974, 2008, for whatever reason, they always seem to happen under Republican administrations. And I think one reason is because the Republicans are seen as being more pro-market, more, like it causes investors to become like kind of irrational and exuberant, and they go on margin and they do stupid things and they get too much leverage, and the bust happens under them. And ironically, like a lot of the people you would not consider have pro-market policies like Obama or just recently, Biden, the stock market does great. So it's not always as simple as you think. And I'm just worried that right now the market is just priced in a lot of this exuberance over like potential like pro-market Trump policies. And at some point could, top out and go lower. And it could just go lower because there was really no trigger in 1929. There was no geopolitical event. There was no anything. It was just the market got overvalued and the Fed actually tightened again. Who knows? Let's say the S&P blows off to 7 or 8,000. I don't know. Right. Well, what's to say the Fed might say, oh, no, this is getting too frothy. And they go back to tightening. Right. So maybe that burst the bubble. I don't know what it is, but I do know, we saw that with NVIDIA the other day, that NVIDIA's got this sky high valuation. Everyone is bullish on the stock. And then this news comes out from China and that whacks the company down 16% in a day. And it shows you that when you are overvalued, how susceptible these things can be to declines.
Yeah. Okay. So you're in good company. Let me say that. This is a channel full of libertarians. So welcome to the club. And that also causes you to be a bit of a contrarian. And when you look across at a lot of the common sentiment indicators, value indicators, whether you're looking at the Buffett indicator, CAPE ratio, whatever it is, these things are just screaming caution. Whereas the alarm bells that should be going off in your head is most people are like everything's butterflies and ice cream and the stock market's just going to keep going.
Yeah. And I think that's always the case. It's just, that old saying, bull markets climb a wall worry, right? Well, I don't really see the worry right now. Right now, I see like people just, I don't know if you know who Neil Ferguson is. He's a professor he's been a professor at Oxford and Harvard, but he's a conservative, by the way. He's not the typical kind of left-wing professor and whatnot. And he talked about that 5 years ago at Davos. Everyone was, like accrediting Greta, and it was all pro this environmental movement and this and that. And he said now everyone is negative on Europe, negative on the rest of the world, and they're positive on the US. And like Davos is the most, regardless of the conspiracy theories about them controlling the world or whatever, but in terms of just investor sentiment, that's about as mainstream view as you're going to get is at Davos, right? And if they all believe that, even a lot of them wouldn't even like Trump, right? Or believe in his policies. I would just think that that's probably, again, a contrary kind of indicator. And like I said, I don't think it's going to happen right away. I think what we're going to see is, maybe some of these Trump policies, and he says something that's good for a sector or a market, can kind of influence the market in the short term. But I think at some point, you're going to see a top over the next, and it's so tough to call these things, like over the next year or two, though. And then you're going to, I think the next market decline will be quite significant, at the very least, like 2022, which was about 25%, 25 to 30% on the S&P, and maybe larger with, again, the extreme sentiment and valuations we're seeing in the market right now. And what I think one thing that could trigger it is, we talk about the financial crisis, where the epicenter of the crisis was, obviously in financial companies and banking, and then the government had to bail them out. I think it could be some kind of fiscal sovereign debt crisis, because what's interesting is, even with the creation of Doge, is I don't think that's going to be enough. Like for example, if Trump were to do like a huge tax cut of say $1 trillion a year or something, I think Doge is maybe going to cut a couple $100 billion, and the deficit is $2 trillion a year right now. So that would blow up the deficit even more. And I think the bond market could revolt. And by the way, the same thing happened in the UK. I think it was in 2022. They tried to do a tax cut in the UK without a corresponding spending cut. And the bond market revolted and the yields blew out, and they had to take back that unfunded tax cut. So, and I'm being, again, living a libertarian, I'm all for tax cuts. But the issue I have is when you have $5 trillion of government spending, and, I talk about this stuff I do talk about in the book, in Social Security, Medicaid, Medicare, military, interest. Well, you can't cut that stuff, really.
Yeah.
So you only have the $2 trillion of discretionary spending you can play around with.
Yep, a lot of that is what are they don't call it required funding. It's anyways, it's mandated that they can't cut it. So let's go into, let's hit listener questions real quick.
Okay.
Fiat is Dead had a question on Discovery Silver. That isn't one that you follow, or it is?
I don't really follow it. I was like, I was looking at it just because the question was there. So I could see it had a huge spike recently. If he writes me a personal email, I will get back to him on that. And I'm sure they had, I'm just on stock charts looking at it. I haven't looked at the news. I am sure they had some kind of significant news play to basically cause that to happen. So, but I will say, just in general, the concept of a company like Discovery Silver, these are the type of companies I like at this phase in the market, kind of those mid-tier companies that have a resource, are expanding on it, etc. At this phase now, with silver above $30, gold above 2,700, these are the kind of companies that can really move. Like a company I like, it's not a silver company, but I like New Gold. And
Okay.
New Gold actually is breaking out to a new high today in Canadian
Oh,
dollars.
can you share your screen on that one?
Yeah, let me I'll get the American dollar chart. It's close in American dollars. Let me share the screen. 1 second. Let me get into our meeting here. So you have my screen share on?
Yeah.
Okay, so this is New Gold, and you can see, so that's the American dollar chart, NGD, and you can see the short-term downtrend that kind of came in, from the top back in September, October, has been broken. And, being Canadian, I can tell you, like, you can see the Canadian chart because of the weakness of Canadian dollar. New Gold's basically at a new high today. So this is a mid-tier company. So these are the kind of companies I think that can really, really outperform. Like another one of my favorites in bull markets is Eldorado. You can see that's still kind of in a downturn. But note that Eldorado, when the move in gold happened from February, this went from $10.50 to $19. It went up 80%. Gold went up 30%.
Yeah.
So these kind of mid tiers are much more, I would say, leveraged when the upturn comes. And if we go look, remember the company I talked about when we had our first interview, Endeavor, which I think I talked about it right at the bottom when we had our first interview at a buck 50, and it
Mm-hmm.
went to 550, and you can see that looks like it's up 8% today. That's breaking out as well. So these are the kind of companies, like, it's okay if you want to own Agnico Eagle or Newmont or Barrick, that's fine, or GDX or GXJ. But I think these are the kind of companies that will outperform, are these smaller cap, mid-tier type companies, because they're more leveraged to the price and the underlying commodity.
Yeah, not only is it breaking out on the price action right there too, but the MACD is looking pretty good.
Yeah, and I like that too with the RSI,
Yeah.
where it kind of bottomed at 30, 40. Now it's coming above 50, and we're not overbought yet. So
Yeah.
that looks like, to me, like it can move higher. And by the way, another trading strategy with these companies is you gotta buy the dips and sell the rips. You don't like, if you want to buy Endeavor today, I think it's still okay because it's coming out of that oversold, but you don't buy it when it was at $5 in July or 550 in November. You buy it on those pullbacks like you saw in August, September, or you saw into early this year. So that's kind of when you want to buy these companies, So
Yeah.
uh,
Yeah.
yeah.
Derek has a question. He says, "Are you still bullish on Aftermath silver?"
Yeah, I'm gonna put that up right now. Yeah, Aftermath. Okay, so they have like some magnesium and these other weird metals they're kind of into as well. That Eric Sprott put in a lot of money because of that. So if you go look at it, Sprott put a crap load of money into this company recently.
Hmm.
And what I like about Aftermath, and I'm going to go back and show you like a 6-year chart, because I invested in kind of the seed financing when it was an 8-cent junior when they took over the silver property that they have. You can see that was back here in
Oh,
2019.
nice catch.
And yeah, I didn't, just so you know, I got out around 50, 60 cents. I wish I would have held a buck 50.
Yeah.
So, but this is a leverage play on silver because they have a large silver resource. It's a past producing mine. And it's again, it's a smaller cap company. So this is the kind of company where, like, if silver goes to 40 or something, maybe it goes back to these highs. What you have to understand is they have raised a lot of money in the 4 years since those highs. So the market cap now is probably almost the same as it was in 2021 at those highs, because they've raised, they have to issue shares, etc. That's one thing you have to look at with these juniors. But yeah, if you go look at it, Aftermath had this great basing move here,
Yeah.
back in 2022, 2023, broke out, and now, spiked to nearly 70 cents when silver had the spike into last fall.
Yeah.
And you can see it's kind of breaking out. I'll get a shorter term chart now so we can see that. It's kind of breaking out here above this kind of short-term resistance around,
Yeah.
the early 50s. So this looks to me like it could go back to the highs, and you can see it never really broke the 150-day, which is the blue line,
Hmm.
and definitely the 200-day moving average. It kind of held up during this whole kind of uptrend that's been intact since February. So yeah, I would continue to hold this, and as a trading position, I would definitely look at buying this. Like, this is, to me, like something that could continue to go higher. And I'll just quickly look at, which I'm just going to show you the SLV for a second. Just, you can
Yeah.
see too. To me, this is very constructive. A nice base that's kind of been forming, and looks to me like we can go back to these highs here. And by the way, this comes back to that whole debt situation I talked about. I keep telling people, if we're going to really have this big economic boom and whatever, why are gold and silver still moving?
Yeah.
you know,
Yeah.
I think they're kind of sensing something, So
Yeah, maybe pull up the gold chart real quick and we've had a heck of a move in gold as we're talking
putting up
Thursday,
the
January 30th, and this episode will come out in 2 days, so on the weekend. What do you see? Not necessarily GLD, but gold itself has
Well, I'm putting up GLD because gold is on stock charts is like a day late, right? Like,
oh, okay, okay.
yeah, it's the close of the futures or whatever, or the cash. So, but you can see here we're actually breaking it. Like, we're right at the high of October, right?
Yeah,
And it looks like we're about to break out here. And if we break out here, I think the next move is probably to 3,000. If we go look at this consolidation that happened here, kind of
yeah,
April, May, June, it's very similar to the consolidation that had here. Now, it didn't quite start to run in July, so maybe we see that kind of pullback, but that only lasted a few weeks.
yeah.
And then essentially the market moved straight higher. So that's kind of what I'm looking at here. And I'm just going to show you quickly the US dollar. I do wonder if it has topped in here, right? Because
Yeah.
thing happened in 2026. I'll get you in USD show chart with Trump when he got elected, is that there was a huge dollar rally. We'll get a 10-year chart so I can see this. There was a huge dollar rally here. You can see like this, right?
Hmm.
And this dollar rally here, by the way, was because when they raised interest rates.
Yeah.
And and then when Trump got elected, almost immediately, he started talking the currency lower. And we all know Trump is big into trade and the whatnot. So he's not going to want the dollar too strong. So I do wonder if he'll start talking the dollar lower like he did in 2017.
How do you talk the dollar lower?
Oh, you just start yelling at China and the yen and wherever, saying you're all manipulating your currencies and we're going to do this and that, and that's he'll start doing that, in my opinion, as well,
Okay.
right?
Okay.
So like, yeah, yeah, and he'll start yelling at the Fed. He's going to start yelling at the Fed to cut interest rates. He's already said this, like he wants interest rates lower, you know. So the Fed right now is, as we both know, is kind of in the stand pat mode,
Yeah.
right? But I think he's going to start yelling at them. Like that's what happened in 2018. He got really aggressive with the Fed when the Fed was raising rates from 0 to about 2.5% in 2018, and then the Fed started to cut in 2019, and then of course they cut back to 0 during COVID. So I think he's going to be really aggressive on the Fed about cutting interest rates because he wants to stimulate the economy even more.
Yeah. Okay. All righty. Let's go into your book. I read it, and well done, sir. You're a very good author, and you illustrate and articulate your positions so that I think laymen can get it. Guys like me. So really good. It's called Mega Returns: Profit from Maximum Pessimism. I like the title. Maybe just kind of give us an overview of your inspiration for it, and kind of give us the cliff notes.
Well, like when I started in the late 90s, I'm 47. So when I started in the late 90s, I was like more of a gold and silver type bug, and I thought that the market was in a bubble. And so I really focused. My first book was called Stock Market Panic. Actually, if you go look at my name on Amazon, you have to type in Dave, not David Skarica, to see Stock Market Panic, because I guess when I was younger, I called myself Dave. But anyhow, anyhow, so and that was more like again hard. Right then, commodities have been in a huge bear market since the early '80s, and I just talked about how basically the thesis of that book was stocks are in a bubble, and you want to buy hard assets and commodities. And this is a bit, it's kind of funny, 26, 27 years later, it's kind of come full circle because I believe that again. But and also I've learned a lot about value investing, buying assets when they're cheap. And, I moved to the Bahamas in 2005. And when I started reading a lot about investing and past gurus, John Templeton kind of came up all the time. And then I found it interesting because he moved to the Bahamas in the 60s. And that was before kind of moving offshore became in vogue. And he was American, and because Americans can't get out of all the taxes. He found a loophole. I won't bore people with that, a way to do it. But anyhow, he died in 2018, and I actually went to his funeral and, or sorry, his memorial and all this sort of thing. And anyhow, when I started reading more about him, and I found this really interesting, all the trades that he did. There's a book called Vesting the Templeton Way, which is written by his niece, Lauren Templeton. And it talks about all the trades he would do. And he just looked for beaten up assets and then buy them and hold them for 2, 3 to 5 years. And I was like, yeah, this is really interesting in the way it works. And I started to do that in not till in my 30s. I was very active in junior mining and gold and silver. And my first trade in that really was with Tata Motors, which was the Indian car maker, which owns Jaguar and Land Rover as well. And it collapsed from like $35 to $350 during the financial crisis in 2009, and it ended up going back to $50. I bought it like right at almost the lows. I think I sold it around 20, $30, that kind of thing.
Nice.
And that was my first trade in it. And then I bought HL Toy, which was the Greek telecom company in 2012 when Greece was having their crisis, and that did very well. I think my subscribers made about 5x on it. And so I was like, yeah, this is really the way to go. And it was even during this big bubble of the last 15 years where asset prices have gone up and up. like I said, you've had Greece and the pig countries in 2012. There was Russia in 2014. There's been other like individual sectors, commodities in 2015, 2016, that every 2 to 3 years, there seems to be an opportunity that comes up where you can buy assets cheap. And that's really more the thesis of the book, that just wait, be patient, wait for something that is cheap, and then you can buy it. And there's a study by a guy named Maybain Faber, not Mark Faber, Maybain Faber, who runs funds in the States. I love Mark Faber too, by the way. But so this guy did a study showing that when assets go down between 70 to 90%, like the 3 4 year returns are like in the hundreds of percent afterwards. So it's nice to chase Nvidia, or it's nice to chase, Apple or whatever.
Or Tesla or whatever. Yeah.
Tesla. But the thing is, like, I bought a streaming company, and you can see it on my website and on my YouTube page. I did a video on it saying this is my favorite company. This is last July. It's called Fubo TV. They stream sports and they stream TV and etc. And it was like 140 a share. And I've been actually, in fairness, I've been recommending for a couple of years in that 140, 150 area. And they made a deal with Disney early in the year, and the stock spiked to over $5. It's like $4 now. And buying something cheap like that, which has probably pretty limited downside, and trying to make 2, 3, 4x on your money is, my opinion, I don't want to say easier because it's tough to find the undervalued companies, but it's a safer way to try to find big returns, quote unquote, mega returns, than, because the problem with NVIDIA is, I don't know if you know the guy, he's called the Asset Investor or whatever. He's a Scottish guy. He's really unique character.
Yeah, I've seen him on YouTube. Yeah.
Yeah. He kind of got long hair like me. And he said the problem I have with NVIDIA is I don't know if it's going to double or if it's going to go down 80%. Right. So when I bought Fubo at like $1.25 to $1.50, I'm like, well, this might go down 20, 30%, but I think it's going to go up 200 or 300%. Doug Casey used to have an old saying, I rather bet a dime to make a dollar than the other way around. Right. So it's, that's kind of the thesis of it, is that try to find these cheap assets. And because there is maximum pessimism, that's what Templeton called it, by the way. He called it buying at the point of maximum pessimism, when everybody hates something. Right. Kind of the opposite of what we were talking about with the stock market right now. Right. Kind of like buying the stock market in 2009. So when everybody hates something, that's kind of when you buy. And then that's usually when your largest returns. And by the way, and it kind of combines with Soros's theory of reflexivity, where markets overshoot one way or another. Whatever you think of Soros politically, is I really like his theories on markets. And so Soros talked about reflexivity, and when you get those moves out up off a maximum pessimism bottom, you can get those 2, 3, 400% gains, and not years but months. Like a stock that did this, I didn't buy it unfortunately, but is Las Vegas Sands, the casino company. It went to like $1 or $2 in the financial crisis, and within 2 or 3 years, it was trading back at $50.
Wow.
Yeah. So and because everyone thought the casinos, because of their debt loads, real estate bust, everyone thought they were going to go bankrupt. So that's when you kind of got to hold your nose, and maybe you don't want to risk losing everything because it could go bankrupt. But if you whatever your disposable income is, like if you can afford $1,000, 5,000, 10,000, 100,000, you could have bought Las Vegas Sands. Okay, you're not going to get the exact bottom. Say you bought it at $2, right? And you can like hope that it can move higher. When that reflexive move happens. And the last thing I'll say, this is kind of a theory I've added to it. I think you need a catalyst. Like, for example, with Fubo, what I saw as a catalyst was is that they were trading at a quarter of revenues. They had a $400 million market cap, and they were doing 1.6 billion in revenues, right? When I bought it, they were growing at 20% a year, and they did an antitrust lawsuit against Disney and all these big, I think ESPN's part of Disney, Fox. So ESPN, Fox, I'll do a quick version of the story. They were trying to do what's called a skinny package. So they wanted to set up a streaming service called Venue. And what they wanted to do with Venue is just, okay, for $40 a month, you're just getting sports. Well, Fubo offered them that, like, hey, what we like to do is work with you guys, just carry sports packages and sell it for like $40, $50 a Fubo. And they rejected Fubo. So then Fubo came back and said, well, we're going to do an antitrust lawsuit against you, right? Because we wanted to do the exact same thing. You rejected it, and now you're doing it yourselves, right? So I think they were going to win the antitrust lawsuit, and that's part of the reason Disney made a deal with them. So again, I saw growing revenues. It was cheap, and this potential like a bonus from the antitrust lawsuit, and so they had catalysts there because there's a lot of companies that are cheap and beat up, but if their prospects are still bad and there's no way they can turn around, you can't really buy them. Like the last, like Templeton made a trade just to finish off on this. His first famous trade in the 30s. He borrowed $10,000 from a colleague, which is like 150,000 in today's money. And he bought 100 companies trading under $1 a share. So basically penny stocks. A lot of them were railroads. A lot of the companies were in bankruptcy. This was the late 1930s. And he saw that Europe was going to go to war and that the US, being an industrial powerhouse at the time, was going to supply, the Western powers, the Allied powers, with all of their, munitions and materials and tanks and planes and boats, etc. And he saw this is going to really like take the U.S. economy out of the Great Depression. So there's the catalyst, and he turned that 10,000 into 100,000 in like 4 or 5 years. So he saw the catalyst. So I think I would say that's another important aspect to it. Like I said, a lot of companies can just like stay in the doldrums for years, but you need to see this catalyst that can take it higher. Like right now, I'm long a couple of the 3D printers. They're all off 95% or more from their 2014 highs, but there's stuff happening in 3D printing right now that I think is a real catalyst to the industry. So I think on top of just buying the cheap assets, you have to have a catalyst. And last thing I'll say is when a market collapses, like say Russia in 1998 or the US in 2009, well, the catalyst is usually the central banks are going to come there, cut interest rates, be very stimulative. So you have that catalyst. But when you're just looking for individual companies or a sector that's beaten up when the rest of the market is doing fine, you really have to find that catalyst.
Okay. One of the things I really liked in your book was you're talking about the next big short. Basically, it's not really something you're going to get rich off of, but you're not going to grenade your account either. It's essentially a hedge.
Yeah.
Can you go into that?
Yeah. So like I know I talked about a sovereign debt crisis, but I wanted to find a cheaper way to play it, right? An easier way to play it. Because if you go look at 2009 or 2020, when there were these big busts in the stock market, well, the TLT, so government bonds, got a bid, right? So I wanted to find something that's going to fall during a crisis. And then what I found was interesting because of the whole cheap money bubble during the 2010s until now, I was like, well, the LQD, which is the corporate investment grade bond, has taken off. And all of the McDonald's, Apple, it doesn't matter what the company and what sector it was, all of these companies have taken on a ton of debt because they could get the debt so cheap, right? From 2010, 2009 till basically the last year or two. And, especially during 2020, 2021, when rates went to zero and the 10-year bond yield went to 0.5%. So Jeff Gundlach talked about it, the big bond manager, and he said that, and this is 2019, he said this even before all this debt was issued. He said that if interest rates normalize, on corporate bonds, these companies have taken on so much debt, they normalize, 2/3 of the investment grade corporation bonds will be junk. I mean, the companies will be junk because that debt load and interest payment will be so high and such a large percentage of the revenues and cash flow. They'll be like junk debt companies, right? So I was like, that's really interesting. So then I started looking into it myself, and I was looking at the investment corporate ETFs, and I was like, I came on LQD, which is the largest of them, and I was like, well, I looked at the options on it. I'm like, well, because investment grade bonds are usually conservative and usually don't have a lot of volatility, there's no implied volatility on these options. And if you don't even need a huge move, like you don't need this collapse 50% in price. I'm like, if the LQD goes down, I don't know, 20, 30%, or 10, 20% in price. And by the way, that's what it did in 2022. So this has happened in recent times. That's what it did, by the way, in 2020 during that quick COVID crash in the markets. So if this does that, you can make 10, 15, 20 times on your money with only a 10 or 20% decline. Where like if you are going to be shorting, Netflix or Tesla or these high flyers with puts, their implied volatility and premiums are gigantic, and you're going to need 60, 70, 80% decline to get those kind of returns. So I thought it was an interesting way. And also the thesis is this: if inflation picks up and rates go up, the LQD is going to sell off. That's what happened in 2022. But if there's a kind of crisis and crash, okay, maybe government bonds will get a short-term bid in that. But if you go look at 2008 and you go look at 2020, the LQD tanked with the market. It didn't trade with the government bond market. So I think either way, in one of those two scenarios, you can make money. And like you said, you're not going to get killed on it because the premiums are so low. You can buy 2 years out and they're not that expensive. And like I said, you could put, I don't know, 0.5% or 1% of your portfolio in it. And it kind of becomes like, like a Talib black swan type hedge where wait, it doesn't work out, whatever. You lose 0.5% It's like over 2 years. It's like, it's not going to really, ruin your life. But if it works out, well, let's say it did go up 20-fold, you'll make, your 0.5% goes to 10% of your portfolio, and you hedge any potential losses you have in stocks.
Yeah, I'm going to share my screen here so viewers can just kind of get a visual representation of what you're talking about. So you're looking for moments like this, like COVID, when this thing's trading up at 130 and then bam, you got this awesome moment where it goes down to 105, or here 2022, even from 114 down to 98. If you get something like that, that's going to be a massive return on a long dated put on this thing.
By the way, I first looked at this trade in 2017. That's when I came up with the idea, right? And in so it was 2018 when they started raising interest rates.
Yeah.
I remember I made that trade and I made 3 or 4 times on my money just in that little move down in 2018.
Oh, wow.
So,
okay.
Yeah. So imagine, like I said, it only went from 120 to 107 or 110. It wasn't like some huge, decline. And it's because the implied volatility is so low that, and remember, here's the second part of it. So not only do you get, the price decline increases the price of your puts, the volatility premiums start to blow out. Volatility goes higher. So then the price goes higher because of that. So the implied volatility goes from like 3 or 4%. And by the way, that's all they are on these on the LQD, right? And if that goes to 30 or 40%, you're getting 10x gain just off the blowout in the premiums.
Very cool. Very cool. That is a neat way for retail to be able to hedge their portfolio and make it pretty cheap.
Who also made a similar trade to this? I just want to show that examples of stuff like this has worked in the past. I don't know if you ever heard of Martin Zweig. He wrote a book called Winning on Wall Street, and he became famous because he hedged his portfolio right before the 87 crash. And same thing, he was buying puts on the S&P. I think he put like 1% of his fund in it, and they sold it like Wednesday, Thursday, Friday, Monday, Tuesday. That was the crash in 87. Tuesday morning, the market gapped down before it turned higher. And he sold it 20% at a time. And the last trades he made on the Monday crash and the Tuesday morning were insane because the VIX was like 100, and the volatility, like he was actually paying. So like, say his puts were like $50 out of the, like $50 to zero. Like he was buying $50, whatever S&P puts. I'm using this example. Like he was selling them for $100. They're playing twice of like, the price till zero because people were just panicking. And back then there was a lot of writing of puts because the market was going straight up for years. And then writing of puts, people are doing that on margin, like they short stocks. So they just had to buy back at any level. So the premiums blew out, et cetera. So so what I've done with, it's not just like, I've kind of taken all of these things as Wag did with that, combined with the big short thing. And what I love about this trade, just to end off here, is none of us schlubs could do mortgage-backed securities, right? We've seen the big short. We know what those guys had to do. The kind of money, even those 2 guys that work with the Brad Pitt character, they had to get a special, terms because they weren't big enough and they had tens of millions of dollars. So this is a way an average person can do it. You don't need, MB, you don't need swaps and all this crap, So.
Yeah. And if you don't have options, it's Probably too easy to get approved for them. I recently did it on another brokerage account and I literally clicked a few buttons and voila, I was approved. So you can get approved for these things real easily. And I didn't even need to talk to a human. So
Well, how I made most of my money on that Fubo stock was actually I let the market stop me out in some of my position, right? Because it was just going up and down and up and down and but I had this option position. It was out of money options, and they became so worthless when the stock went down a bit. I just kept them, and then all of a sudden Fubo gaps up, and I made like 4 or 5 times on my money on this, which did really really well on this option position, right? So, you
nice.
know.
Nice. Okay. Let's move on to you talk about a shifting of power. And so you say that there's kind of been two sets of power throughout the United States' history. It's either kind of centered on the political side or centered on the central bank financial side. And you're starting to see a shift in that. Can you elaborate?
Yeah, well, the one problem with the shift in power, where I could be wrong, is that if there's a debt crisis, then it kind of limits what the government can do. But I do think what's going to happen, even if there is a debt crisis, is that I think there was a shift in the early 80s, and this happened both in the UK and the US, because you had similar, beliefs like politically with Reagan and Thatcher, where they made it more about financial markets and deregulation and liberalization and it was like really Wall Street and the British financial sector really began to Canary Wharf really began to run everything, and then that's when we've seen these huge booms and bubbles and asset prices and be it real estate, stock prices, etc. And what's interesting, what I find is, even when Trump talks about doing tariffs or like stimulus packages to rebuild infrastructure, Jeremy Corbyn wanted to set up a bank in the UK that would basically rebuild infrastructure in the company. I think there's going to be shift back to political power. And maybe even if there's a debt crisis, that could still happen because people will be like, oh, well, all these guys in the financial community just caused these bubbles, made all this money for themselves. Now we have to kind of let this trickle back down to the working man and stuff. And tariffs are really about that. They're like about protecting your own industry, right? And not worrying about globalization anymore. So I think this shift is going to happen where, like, even if there's debt problems, they're going to try to get the Fed or whatever to monetize the debt anyhow. And you're going to see any spending or any stimulus, not like a financial bailout like 2008, 2009, but it's going to be like a common man bailout where it's just like, where, you're in California and you told me you're, what you did for a living. And it's like, they're going to try to give bailouts to people to rebuild and whatnot. And okay, maybe there's going to affect where BlackRock and these companies will benefit from that. But I think what you're going to see going forward is that where the politicians, especially with like these big characters like Trump, are going to have more power because the financial community has benefited so much, and the average person has been so hard hit that they're going to try to give money back to the average person. And I would say that tariffs are definitely an offshoot of that. Like that's, again, trying to protect your own industry, trying to protect workers, that sort of thing. So I think there's going to be the shift. I call it hyper-normalization. And when I talk about that, there's a guy named Adam Curtis. I'm dropping so many names. But anyhow, he did for BBC, he did a documentary called that. And it was basically based on the Soviet Union. And at the end of the Soviet Union, we all think, oh, they're just evil commies. But really, if you go look at what happened there in the 70s and 80s, the average person in the Soviet Union was like, this sucks. This is not working, And we're all getting poorer. And even though we see all this increase in technology and housing prices going up and cheap money and blah, 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 the average person's standard of living is going lower. And hyper normalization almost seems like the prosperity is fake. If you go to rich areas of Manhattan or of London, like these buildings are empty half the time, right? Because it's rich Chinese or Indians or whoever own them, right? And that's not really benefiting the average person. And I think that will lead to an offset where the politicians are going to have to appease the average person more, going forward at some point.
Okay. I piggybacking off that, I was just up in Vancouver for a couple of conferences, and I noticed that quite a bit. I was talking with the listener, and he was pretty frustrated at the Vancouver real estate market because he wanted in. And he's like, we're just completely priced out. And, you kind of give a reason in your book is there's a lot of foreign investment has been brought in and they're just trying to find places to put their dollars and they're putting it in Vancouver real estate.
Well, in Canada, especially, like a lot of the Chinese money is essentially money laundering. Sorry, that's what it is, and it's just looking to get out of China. And Canada has very weak white collar crime laws. That goes back. I don't know if you remember the Bre-X, the fraud, that money, that
Oh,
movie
yeah.
Gold, based on that, and it was because and no one got convicted, and that was like at the time one of the biggest corporate frauds of all time, right? I think it was the biggest in Canadian economy at the time, and so like Canada kind of turns a blind eye to that because what happened is because the baby boomers or say older Gen Xers like me that owned real estate, they really benefited from it, right? So they kind of turned a blind eye. And like you said, it's so unaffordable. And now with interest rates normalizing, the average person can't buy a place. So yeah, I think something has to happen. I think again, part of that populism or political power doesn't all have to be government spending. It could be even one of the women who's East Indian who's running for the Liberals in Canada. She's agreeing with like Trump and the conservative leader in Canada about doing mass deportations. So that is again kind of a populist slash like political power move where okay, we can get real estate prices down. That if there's a bunch of people here illegally who do own homes or at least rent, and then the renters can charge over the top rents because basically there's no vacancy. If we basically kick them out of the country, that will decrease prices and then help like the normal person in Canada or US or wherever. So I think that's definitely going to happen. So as well. So I don't know what Canada's going to do though, because their prices are so much higher in the States, especially in places like Toronto and Vancouver. I think they can go down 30-40%. The average person still can't afford it. So that's a major issue going forward. And then you get, I don't get into conspiracy theories about, they want you to own nothing, but like, it does make sense when you see things like that occurring, so,
Yeah.
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 When you have foreign investment coming in like that and it's so encouraged. Okay. Oil and gas. So you feel so strongly about this, you devoted a whole chapter in your book on it. Give us your macro outlook for oil and gas.
Oil and gas, even though like longer term, I believe that all these government debts and money printing is going to lead to inflation. Short term, I'm not that positive. And the reason being is the whole thing with drill, baby drill and, Biden and Trudeau kind of being anti-energy and pro-climate change and hurting the industries. Okay, that's the truth, maybe like, politically, but if you go look at US oil and gas production, it's 13 million barrels a day. No country in the history of the world has ever produced 13 million barrels a day. No, maybe Russia and Saudi Arabia could. They kind of choose not to. And the reason I'm saying they choose not to is they want to keep oil and gas prices high because that's their whole economy, right? So they want to limit supply. But in Canada, for example, even in the 10 years under Trudeau, oil and gas production went up 20%. And it's up like 60 or 70% since 2009. So there is a kind of a supply glut. And here's something no one ever talks about right now. 65% of the new oil and gas demand over the last 20 years has come from China. So that means that there's 10 million barrels of new demand over whatever a certain time period. 6.5 of that has come from China. And China is, their interest rates are going lower. They look like they're kind of becoming the new Japan. Their population is starting to decrease. They're seeing deflation. They may start exporting deflation. So that's the issue in the short term is that you can say drill, baby, drill, but there's kind of a little bit of an oil glut right now. So if there's a recession and demand goes down, you could see a big whack in oil gas prices in the short to intermediate term, but that will cause supply destruction. And then if that, the response to that is money printing and cutting interest rates and blah, 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 well, then you're going to see oil and gas recovery. So short to intermediate term, I'm really not that positive. Like, I think we're in this kind of range, and I think the price of oil will show that to be true. And, and I think that we probably need a recession to wash out. There's been a lot of bad debt issued for the fracking boom in the United States. A lot of those frackers aren't still overly profitable. So I think we need a recession, maybe short term, like I said, intermediate term decline. But then the whole maximum pessimism thing, that's when I think you should be buying after that right now. So I own a couple natural gas companies, like I own Enbridge, for example. It's more of a pipeline company, but right now I would be very, very patient. And by the way, the country I really like for oil and gas, if you're going to buy, stocks going forward, and you're going to, a lot of people right now will roll their eyes because what's going on politically up there is actually the Canadian plays,
Yeah.
Suncor. There's a smaller one called Athabasca. And the reason I like these is that if if and when Paul Revere, the conservative leader, wins, there's going to be pipelines built, not just Keystone, but like to the to the coasts to export oil and gas, natural gas, etc. And I think that's really, really going to help these companies, and and I think their production can really explode at that point. So I really like the Canadian oil and gas companies once that can happen. Because what's happened under the Trudeau regime in terms of being anti-oil and gas was way worse than what happened under Obama and Biden. Like actually, the fracking boom happened under Obama. So like Trudeau has actually gone out of his way to try to hurt the industry, and that's ironic because right now with the trade war stuff, they're using Canadian oil and gas as leverage, right? So he tried to kill the industry, and now he's using that industry as leverage, in the trade tariff negotiations. But I really like those Canadian plays. I wouldn't buy them at these levels here, but definitely going forward, I would. And here's another reason I like to buy them is that I think that Paul Revere, he's a smart guy. He's going to set up a lot of the refining capacity in Canada rather than be dependent on the United States. And right now, those companies sell their oil and gas at a huge discount to the United States to be refined there. So if it's refined in Canada, they're going to get a much better price for it as well.
Oh, I didn't know he was open to opening up their own refineries because, right now, that
I
heavy
think
sour's got to come down to the Gulf to get
I
processed.
I really believe the Trump rhetoric will kind of blow up in his face that way, where Canada is going to say, we can't be so dependent on this. Because what happens if you get a president talking with this rhetoric, right? So, and like I said, I think Paul Revere is going to really push for like inter country pipelines that go to the coasts rather than being totally. Like, they'll still export a lot of it to the states, but I really believe that's something that's going to happen. I think strategically that's a smart thing too. It's like we all know Canada's U.S. like younger brother or sister, what do you want to call it, smaller, but like, it's always going to be, they're always biggest trading partners, always going to be the states. But I think you can't be as dependent. Like they wanted to do a pipeline that went out east, and especially after the Russian war, where Germany needed liquefied natural gas and stuff. Like it would have been a boon to Canadian industry, but Trudeau was against it because of climate change. So
Yeah, yeah. Okay, I know another one that will hit with this audience hard is rare earth metals and PGMs, platinum and palladium. What are your thoughts on those?
I've never been a lithium guy. The reason is I'm gonna be very blunt and um, look, I've been doing this for a long time. When I started in the late 90s, I saw all these little Vancouver mining stocks turn into .com and telcos, and they all went up like crazy during 99 and 2000, and then they all crashed, right? There was one stock I'll tell you a quick story. I don't know if I've told it on a bunch of podcasts, but it was called Wave Telecom. It used to be called Grand Columbia, and I just held it because the stock tanked when all the mining stocks tanked after Bre-X, his late 90s. And I bought it like 20 cents. It went to 5 cents. All starts going to 40, 50 cents. And I'm like, wow, this is great. And I sell it, and I'm like, what is going on here? And then I read the article. It turned into like a telecom company called Wave Telecom. WV was the ticker. And it goes to, I sold it all. It goes to $15, you know? And then like 2 years later, I check on it again. I goes, whatever happened to Wave Telecom? It's like 2002, all dog bombs, right? All telecom companies, WorldCom's a fraud, all this stuff. And I look at it and I remember it because it was my birthday, which is September 27th. I'm a Libra. That was the last day it traded in 2001 and it was bankrupt, you know? I'm like, I was okay taking my 2-3x in the so where that gets to lithium is I saw the same thing. All the mining companies, all the gold, silver companies, oil and gas companies, etc. They all turned into like a lot of them turn into lithium plays, to get on the whole EV green energy boom. And then that essentially was the top. And most of these little companies have like tanks. So I don't, there's like ALB, like Albacore, whatever it's called. Oh, sorry,
Oh, Marley.
Marley, sorry.
Yeah.
Yeah, that, even that's come down a lot. Like that's kind of cheap and it's not really expensive, but I just think now too, like Trump's getting rid of the EV mandates, and the problem is too with EVs, like in a place like Canada, they don't work in the cold. Like those batteries have huge problems in the cold, right? And you living in California, I do wonder if one factor in how bad those fires were was all the yuppies in California have got their solar panels and batteries and Teslas, and those all got lit on fire. And those things are like those things are like bombs when they go off, when they those batteries when they go on fire. Like I've seen whole shipping ships get blown, basically burned to the ground because a couple of the EVs on the freight ship got lit on fire. So I just think the EV mandate thing isn't really going to happen the way people think. And if you go look at the price of lithium, that boom and bust, it's just like it's a classic parabolic curve and collapse. And I talk about parabolic curves in the book. And like I also talk about assets. I want to buy them more when they're down 80, 90%. Well, ALB, for example, its top is about 300 and it's 85. So it's only down about 70. Like if ALB maybe got to 30, okay, I'd be interested. But that's still another 2/3 from here. So I'm not really a big lithium guy. And then I always am suspicious of people's motives. And for example, I would think that, and I don't blame him for this, but I would think Elon Musk is happy EV mandates are gone because all the smaller companies, the Rivians, all those kind of companies, they still need the mandates and the subsidies. He doesn't need them anymore. So it's kind of like taking out his competition. So I would think that I'm not overly positive on them, but a company I think that's interesting, it's gone up a lot, and I talked about it in something called Financial Intelligence Report, and I talk about it in the book too, but it could still go up higher, I think, is EOS Energy Enterprises. EOSE is the ticker, and this is a zinc battery company, and they store energy in zinc. Now, zinc isn't as flammable, there's not the problems with the cold, but the problem with zinc batteries opposed to lithium is they don't last as long and they take longer to charge. They're not really meant for EVs, but this is more storage play. And if you have solar panels, natural gas, even old diesel power factories, the gas and diesel goes bad after a while, goes sour. So you can just produce it, store it in these zinc batteries, and then when there's high energy demand, sell it off. So, and they've had contracts recently in California and Texas. And this is a very, very interesting company. It's gone from $1 to about $6. The all-time high is about 30. So I think that, and the thing about zinc is strategically, 75% of world lithium production still comes from China. First of all, there's 100 times more zinc production in the world. And a lot of it is from South America, North America, et cetera. So you're not as dependent on China. Now, this is, again, more of an energy play. And by the way, with AI, you're going to need a lot of more energy storage for what AI, takes to produce, et cetera. That's why they're putting old nuclear plants back into, production, et cetera. And I think that this is also kind of indirectly like an AI energy demand play as well. So EOSE is a ticker on that.
Yeah. What do you think about some of the rare earths and platinum group metals?
I really like platinum and palladium. I think compared to gold right now, they're very cheap. So, and again, I'm always like, I'm still bullish on gold, but I just think that like you want to buy an asset when it's cheaper compared to something else. Palladium is always an interesting play because Russia basically, controls the supply. But if you look at the chart in palladium, that's the kind of chart I love. And like I said, it might not be something that does something short term, but you go look at palladium, well, gold's had this huge run in the last few years from whatever, 1,500 to 2,700. Palladium's gone from 3,000 to 975. And Russia always does this, by the way. They always cut back their supply any other palladium company that's kind of outside of Russia gets the boots. And then they ramp up the supply, they get the boots, and then when it bottoms, then they cut back on the supply and the prices go up, and all the Russian palladium companies make a ton of money. So, but like if you go look at it again, around palladium's around $1,000 an ounce.
Yeah.
I really like it down here. Like compared to gold, that's one of the all. If you like, I'm just going to do this right now as we're talking, if you don't mind.
Here's platinum divided by gold. So I've been looking at this chart for a while, and I mean, up here it was like almost 2.5 ounces of platinum would get you 1 ounce of gold, and right now, for one ounce of gold, you can get almost 3 ounces of platinum. I mean, it's just
You know what? I would say at this point, even though I'm long-term bullish on gold, melt down your gold and turn it into platinum and palladium, and
right here it is for silver. This is platinum divided by silver, and I mean, like right now, you could trade a kilo of silver and get 1 ounce of platinum, and up here it would take you 5 kilos to get 1 ounce of platinum. So I mean, just ratio wise, this is incredibly cheap.
And platinum and palladium are in catalytic converters, right? And if you're taking my side of the fence that, okay, this EV thing isn't going to happen like they think, well, that's perfect scenario for platinum and palladium, right? So I think down here, and I know, like I said, I think I do talk about a palladium a company in the book, but it's like there are very, very few, like pure plays on it. But Sprott does have SPPP, which is the Platinum and Palladium Trust. It trades, $9-10 a share. So if you're just buying the metals and not worried about the companies, that may be a way to do it. And you're getting what I always like about the CEF is that you get gold and silver in the CEF, right? And then and like I said, in the SPPP, you're going to get platinum and palladium. So, and again, I'm looking at it. To me, I don't know if you can put the SPP up for me.
Yeah.
But that's an easy trade right now. That's like you buy it here, you set a stop loss around 850. That's the lows of 2024.
Yep.
And like, if it goes back to the highs, you're going to make 100% on the trade. And again, if it goes to the lows, you're going to lose like 10%,
Yep.
So,
I completely agree. I've been accumulating this thing for a couple of years, waiting on the moment that you're talking about. But
and by the way,
it's only got to go up. I mean, at these levels, at $9, you only got to hit around here, and you have almost a double.
Well, see, that can be a problem with trading in this whole maximum pessimism thing. The perfect example is this. We've talked about uranium in the past, and it's okay. Cameco hit 750 in 2016, right? It didn't really start to break out to 2020. Okay.
Yeah.
At the end of 2020, it broke 12.5, which was the upside resistance. And then, then it went to $50 a share. Okay. Well, it's like, okay, it went from $50 a share, to, like I said, from 750, that's 7 times on your money.
Yeah.
But you had to wait, whatever. In the end, it was would have been about 8 years, but you had to wait 4 years for it to break out. But anyone would make 7 times on their money in 8 years. Everyone would be happy with that. So that's the thing about it is with these kind of trades, often, like I've been just, looking at the 3D printers for years, and they did have a spike after COVID because they were using a lot of 3D printing for syringes and stuff like that. But they, like I said, they need catalysts, and sometimes you just have to wait, and that can be frustrating because if people are making money in NVIDIA and Microsoft and Apple, and you're sitting here waiting on platinum or palladium or Cameco for 3 years making no money, you can feel like an idiot. But then maybe over a 7 or 8 year span, you actually make a lot more money. So and like I said, it's more conservative. It's more it's a less likely to be a loss at the same time. So
yeah, exactly. I started looking at a lot of those funds as just as a different way to store cash. Like CEF is it's volatile cash, but it's still cash in my mind, and they got a copper trust out now. They got the physical uranium trust, and like this one you just brought up, the SPPP. It's volatile cash. Don't get me wrong on that, but when you look at the chart of the DXY, that is too. So
well, look at TLT, look at the bonds. I think bonds have their first total negative returns. That includes even with interest over a 10-year period, like ever. right? Because interest rates have gone up from that 0.5% to like whatever 4 or 5% on the 10-year bond. And also too, like I don't know how many of your listeners are Canadian, because you do have a lot of commodity type listeners. I look at it as, because I even though I live in the Bahamas and I operate in US dollars, but I have a lot of Canadian dollar investments because I do a lot of junior mining. I look at it like, well, if I store my money in CEF or the Platinum Trust or whatever, especially what's happened in the last few months, I'm in US dollars as well. So not only do I get the appreciation of maybe this thing going up in price, but if the Canadian dollar continues to devalue, which I think it will until Paul Revere gets in, it's like you're benefiting from that too. Because even if they do nothing, the Canadian dollar goes 10% down for 10%, you make 10% Canadian dollars.
Yep.
Yeah. So
Yeah. Quite a few. Well, about 15% of the listeners are Canadian. So it's our second largest following. Okay. Awesome book. I love it. There'll be a link down below. It comes out April 1st. So very cool, David.
I got criticized by somebody, but I was like, no, I think that's a good marketing technique. You can be like, don't be fooled by the stock market bubble. You can use so many things with that coming out April. Yeah, April Fool's Day.
I didn't even think of that. Yeah, that's right. Yeah. It's April Fool's Day. Okay.
That's also the guy who told me that, said that. I was like, do you think people really care about April Fool's Day? Like, yeah, no one over the age of 9.
Well, I highly recommend your book. I'm going to take a couple steps in it that I learned. And do you have any closing thoughts? Anything you'd like to close out on?
I know. I just want to say, like, I don't know when it's going to happen. And by the way, I haven't really started to hedge. I got a couple of very small positions because I still think we have a little while to go here. But like I said, when I buy these positions too, I'm buying these super beat up companies. So I don't get overly worried. Like, okay, if the market had a complete crash, everything's going to fall. But I just wanted people to like take a contrarian approach. See, I don't care don't be influenced by your politics. Like just see that there's just way too much overwhelming optimism right now on everything. Like the New York Times wrote a post, like new golden, when Trump was in new golden age. I told my dad to keep that cover because I was like, I want to see where we are in 2-3 years, and like just like take a contrarian approach. And I know this one reason I changed my newsletter to being more media orientated and not selling the monthly subscriptions as much. Like I have a small Patreon. I'm going to start a Substack, but because I didn't like writing a newsletter, because when you write a newsletter, people want like returns the next month. And I'm just like, I just think the way I operate is I don't know if this is going to go up in 2 weeks, 2 months, 2 years. But at some point, these undervalued assets will start to go higher. Just so I talked about with Fubo, I had been looking at Fubo since 2023 when it was under $2 a share. So I had to wait a year and a half to 2 years. But again, when you make 3 or 4x on your money, and you're happy with that after a year or 2 years, right? So I would just tell people to be patient, buy cheap assets. And right now, the easiest thing I think someone should do is not worry about if the S&P is going to 7,000 or 8,000, because we are in the 99th percentile of valuations, and just wait till assets get cheap again. And if you can still get 4 or 5% on a short-term treasury right now, and that's it just it's not like 2020 when you get 0. Like just get your 4 or 5% and simply wait if you don't want to do all this trading and shorting LQD, whatever. And that would be my advice to the average person. So as well.
Awesome. Well, thank you. We'll put all your links down below. They'll be in the pinned comment below. Again, I highly recommend the book. Thank you for writing it.
Yeah. Well, it's taken almost 4 years to get this thing published. So you have to, speaking of patience,
Awesome. Yeah. Right on. Well, thank you for coming back on the show, David. It was always a pleasure, and I look forward to our next one.
Thank you for having me.
And thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.